Your retirement account is making a bet you never agreed to make. Every time the market climbs, the index fund sitting in your 401k buys more of whatever just went up. That is not a strategy. That is a structure. And right now, that structure is buying into a market that one of the most successful investors in history is quietly exiting. Not partially, not cautiously, at a scale that has no precedent in his career. Warren Buffett's company, Berkshire Hathaway, is sitting on $397 billion in cash and short-term Treasury bills. Most people hear that number and assume caution. They see an old man getting conservative, moving to safety, waiting for a deal. That is the surface read. The data tells a different story. Buffett is not hiding. He is positioning. And the last time a capital accumulation this large and this deliberate happened before a major market dislocation, it was not Buffett. It was the railroad barons of 1873 sitting on liquidity while everyone else was leveraged into the infrastructure boom of the century. That parallel is not decorative. It is the mechanism. The mechanism here is called valuation compression. It is not a theory, it is arithmetic. Think of a single lock on a river that every boat in a region must pass through. When sentiment is rising, the lock opens wide, traffic flows, and every boat gets through fast. When the lock closes, it does not matter how good the individual boats are. They all wait. Valuation compression works the same way. When the market's collective willingness to pay a premium for future earnings contracts, it does not contract selectively. It contracts across the entire market, good companies and bad ones alike. Here is how it runs in 3 steps. First, valuations expand beyond what earnings can justify because investors are willing to pay for growth they expect but have not yet seen. Second, the gap between what is being paid and what the business actually earns keeps widening, held open by sentiment and momentum rather than fundamentals. Third, when something shifts the sentiment, the compression reverses at the same speed it expanded. The business survives. The multiple does not. Right now, the price-to-earnings ratio on the broad U.S. market is sitting near 37 times earnings. The historical average is closer to 16. That gap is not unprecedented. But the last time the gap was this wide and this durable, the compression that followed took $5 trillion off the table in 18 months. Buffett has sold more stock in the last 8 quarters than in any comparable period in Berkshire's history. He has not announced a replacement position. The cash is sitting in Treasury bills, earning around 5%, compounding quietly, waiting. The last time he built a cash position at this scale relative to his total portfolio, it was not random. It was 2007. What the 3-step sequence cannot tell you is what the railroad barons of 1873 knew that the market did not. In the early 1870s, the United States was in the middle of the most aggressive infrastructure expansion in its history. Railroads were the AI of their era, the technology that connected everything, enabled everything, and justified almost any valuation because the future they were building seemed limitless. J. Cook & Company, the most prestigious bank in America, had underwritten hundreds of millions of dollars in railroad bonds. The surface narrative was clear. The network was expanding. The country was growing. And anyone not invested in the railroad boom was leaving money on the table. What was actually happening underneath was the mechanism from part 2, running at full speed. Railroad companies had borrowed against future revenues that assumed continuous expansion. The valuations on railroad stocks had priced in growth that required every assumption to be correct simultaneously: land grants, immigration rates, agricultural output, and the continued willingness of European capital to keep funding American infrastructure. When the Vienna Stock Exchange collapsed in May of 1873, European capital stopped flowing. J. Cook ran out of liquidity in September. The New York Stock Exchange closed for 10 days. The investors who held railroad stocks did not lose because the railroads stopped working. The railroads kept running. The investors lost because the premium the market had agreed to pay for future railroad earnings evaporated overnight, and with it, 50 to 80% of the face value of their holdings. The compression took 3 years to complete fully. Recovery to prior valuations took more than a decade. The parallel is not perfect. Today's AI infrastructure is global in a way American railroads were not. The capital structure is more distributed, and Buffett himself has said he sees no specific crash coming. One sentence of honest acknowledgement earns more credibility than a forced perfect match. The mechanism rhymes. It does not repeat exactly. What it does tell you is this: the structure is not identical, but the compression risk is the same. $397 billion earns roughly 5% annually in Treasury bills. That is approximately $19 billion a year in return, risk-free, while the market trades at more than twice its historical earnings multiple. Buffett is not confused about how to deploy capital. He has spent 60 years deploying capital better than almost anyone alive. The cash is not a mistake. It is a statement about the price of everything else. The single most important fact in this video is not the size of the cash position. It is the opportunity cost Buffett is willing to accept to hold it. A man who has compounded capital at roughly 20% annually for 6 decades is choosing to earn 5% rather than buy into a market at these prices. That is the signal, not the number, the choice. The historical record does not promise that valuation compression follows. Sentiment can hold longer than arithmetic says it should. It has before. The market can stay expensive for years, and the investor who sits in cash while it climbs loses real returns every month they wait. Buffett has been early before and has said so publicly. Patience at scale is indistinguishable from caution until the moment it is not. What stands right now is this: the US market is trading at a price-to-earnings ratio more than double its historical average. The single investor with the longest verified track record of buying value and selling excess is holding the largest cash position of his career in the most liquid and lowest risk instrument available. That is not a hidden data point. It is the most visible signal in global finance. And most index investors are positioned in the opposite direction automatically because the structure of passive investing makes that choice for them. The question is not what Buffett knows that you do not. The question is what he is willing to wait for that you are not.